What is going on, everyone? How are you guys doing today? Today's date is February 15th, 2021. My name is Ryan Williams, and we are back with another video. So today is a Monday, which if you guys have been following my channel for a while, you'll know that these days are usually reserved for Market Mondays. However, today is President's Day. It's a national holiday and the stock market is closed, so we're not able to buy any stocks today, unfortunately. Now, having said that, I needed to get a video out for you guys. The last video I posted was last week's Market Mondays, and I was just itching to get something out there, which brings me to the topic of today's video, guys. We are going to be comparing two different REITs side by side. We're going to be talking about SPG, which is Simon Property Group, and FRT, which is Federal Realty Investment Trust. So we are going to dive deep on these two stocks, figure out which one is the best one to invest in, and yeah, we're gonna learn a lot today. And before we get rocking and rolling in today's video, if you guys wouldn't mind doing me just the smallest favor, you know what's coming, give this video a big thumbs up, okay? Be sure to hit that like button, and while you're at it, hit that subscribe button as well so you can stay up to date on all future videos. Fantastic, thank you guys so much for doing that. And now that that's taken care of, without further ado, let's get into it. All right, amigos, so the best place to start, I think, is gonna be to first cover what a REIT is. And if we go over to investopedia.com, which I'll put that up on the screen right now, they define a REIT, which stands for a real estate investment trust, as a company that owns, operates, or finances income-generating real estate. Modeled after mutual funds, REITs pool the capital of numerous investors. This makes it possible for individual investors like you and me to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. So in a nutshell, guys, investing in REITs is more or less fairly similar to investing in actual real estate properties without the headache and without the stress of having to, finance or manage them yourself. So, and while we're on this subject, investing in REITs is more or less kind of the same idea as investing into other dividend stocks like Coca-Cola or 3M or Procter & Gamble, where you just buy them through your brokerage like Robinhood, Charles Schwab, Fidelity, whichever one you use. Super cool, and most of these actually pay a pretty nice dividend, which is why one might want to invest in them. All right, guys, now moving on, there are a handful of different types of REITs, but the ones we are talking about today are both the same kind, and they are called equity REITs. And essentially what these equity REITs do is they own and manage income-producing real estate, and they lease those properties out to tenants instead of just buying and selling at an appreciated value. So it's more symmetrical to like buying and holding real estate versus fixing and flipping, if that makes sense. Furthermore, the two REITs we'll be talking about today, SPG and FRT, own and manage the same type of properties. Both of these companies own, manage, and lease out commercial properties used for things like retail, dining, entertainment, stuff like that. And because both of these REITs are so similar in structure and how they operate, they're pretty ideal for comparison. Which, now that we've covered what a REIT is and a little bit of information on the two we'll be talking about today, let's just go ahead and get right into comparing them. All right, guys, so what we are looking at here is the summary page of both of these stocks on Seeking Alpha, and we are just gonna run through some of these metrics and compare them side by side. We're gonna be doing that throughout the entire video, just on different pages here from Seeking Alpha. So the best place to start is right at the top, guys. Let's go over the share price and the historical performance of both of these stocks. So as we're bouncing back and forth, just looking at the share price at the top, we can see that both of these REITs are priced pretty similarly, between $100, $110. And furthermore, if we go down here, looking at the 1-year performance of both of these, we can see that SPG is down about 20% for the year, and FRT is down about 17.5%. So they're very similar in performance as well. And the same holds true across 5 years. So going back to SPG, sorry, I'm probably moving a little quick here, but SPG down about 40.5% over the last 5 years, and FRT down about 30% over the last 5 years. So just right off the bat, we can tell that not only are these similar in price, so the entry point to both of these REITs is gonna be very similar, but also in terms of performance, they have been performing more or less the same across the last 5 years. They're both down quite a bit, which in my opinion makes them good buys right now because there's a lot of upside potential. And as we move down over here to this little 52-week range, we can see that they're actually at about the same point across the last 52 weeks, sitting, kind of middle towards the top there, which, for both of these, it could be a little bit better, but at least it's not super, super, super expensive. So, all right, guys, now if we scroll down here kind of towards the bottom to the balance sheet section, there are a couple things I wanted to touch on here, and let me do the same for FRT here real quick. Okay, so looking at just a summary of the balance sheet right here on this summary page, what I want to hone in on here is the current debt to equity ratio. And so what we're looking at here is this number right here, this current ratio, the current debt to equity ratio. And what this number reflects is how this company is operating through their debt versus wholly owned funds. So of the assets of the real estate that these companies are leasing out, how much of that do they still owe money on versus how much do they own completely outright? And a good number, just for some context here, a good debt to equity ratio is below like 1.0, okay? And once you get above about 2.0, it starts to become pretty risky. So for SPG here, we can see the current debt to equity ratio is 0.67%, which obviously is below that 1.0, making it a pretty ideal debt to equity ratio. Okay, it seems like they have a pretty good control on their debt. Now, if we move over to FRT real quick, we can see that the same number, the same ratio is 3.77. So substantially higher than SPG's, making this a little bit riskier in terms of debt. They might suggest they don't have as good of a control on their debt. And if this debt to equity ratio is, considerably high above that 2.0 mark, which as you can see this is, it suggests that there's a greater likelihood that this company is not in the most ideal position to pay back their debtors, which, as you can imagine, is not a place you want to be in. Now, bouncing back over to SPG real quick, having a debt to equity ratio that is too low or too far below that 1.0 suggests that your business is over relying on their equity, which can be costly and inefficient, which is also not somewhere you want to be. So you want to be somewhere in the middle, ideally between that 1.0 mark and that 2.0 mark. But I would rather have too low of a debt to equity than too high of a debt to equity ratio, just personally. So kind of wrapping things up on this page before we move on, in my opinion, so far, SPG does have a leg up over FRT just because of this debt to equity ratio. So far as the other metrics we've covered, they're pretty similar, right? Similar in price, similar in performance over the last 1 year, over the last 5 years, but this debt to equity ratio is different between the two. And at least in my mind, SPG's debt to equity is a little more ideal. All right, guys, so moving on, now we are gonna compare the dividends between these two REITs, between these two companies. So just looking at the dividend summary here for SPG, we can see that it has a dividend yield of 4.63%, which is pretty solid, okay? And then moving over to FRT, we can see that the dividend is also looking pretty solid, the dividend yield, 4.14%. So far, the current dividend yield is pretty dang similar. And now let's look at this next number, the payout ratio. So for a REIT, actually, the payout ratio for SPG is pretty low, sitting at almost 53%. If we move over to FRT, we can see this payout ratio is substantially higher, almost at 100%. I'm not entirely sure why SPG's payout ratio is so low compared to FRT's, but I do know as far as REITs go, seeing a number like this is more likely. And for those of you who don't know, what the payout ratio measures is the percentage of profits or the percentage of income the company pays out to shareholders. So out of their net income, SPG pays 52% of that to their shareholders in the form of dividends. And FRT pays 91%, almost 92% of their net income to their shareholders. And it kind of begs the question, guys, where do you want it to be? Is it better to have it at about 50%, or is it better to have it closer to 100%? So if this number is closer to 100%, that means that the company is paying the great majority of their net income to us as shareholders, which doesn't leave much for them to store in the bank to save up. And this net income that isn't paid out to shareholders could actually be used for other things. So it could be used to, in these companies' cases to buy more properties, possibly invest in other ways, or just stack aside for rainy day money in case they find themselves in a tough spot. And so having said all that, typically it's a little bit safer to see a payout ratio more in the lower range compared to this, because if FRT is paying out almost 92% of their net income, it doesn't leave much left over for them to save or reinvest into the business to further operations or whatever else you can use that money for. Most of it is coming to us as shareholders, which is nice, but it comes at the expense of some security in the future. Okay, moving on, guys. I will touch on this growth rate, but first I'd like to go over to the dividend growth. So looking at this, it seems like either this year or last year, SPG did not raise their dividend. It doesn't necessarily mean they stopped paying it, but they didn't increase how much they were paying out. And seeing a company grow their dividend year over year over year is very important, especially for people like us who invest in dividend paying companies. And if we move over to FRT, we can see the complete opposite story. FRT has been growing their dividend for 52 consecutive years, which is awesome. Okay, this is something we like to see. So even despite their high payout ratio, FRT has still been able to consistently grow their dividend year over year over year. And like I said, guys, in a typical stock, in a typical company, if this was like Coca-Cola, if this was Procter & Gamble, if this was 3M, this high of a payout ratio might be scary, but I think the rules apply a little bit differently to REITs, and I'm not 100% sure on the specifics, but I do think legally REITs have to pay out a certain percentage to their shareholders. And I don't know what that percentage is. And going back to what I was saying earlier, if there is something legal telling them they have to pay a certain percentage of their income to shareholders, I don't know why SPGs is sitting so low. I'm gonna do some more research on that. And maybe you guys would have more insight on that. If you do, please leave me a comment below and let me know. All right, guys, so one of the last things I wanna touch on, I kind of bounced over it, but it's this 5-year growth rate. So as we just talked about, SPG recently decided to not increase their dividends. So that kind of nicks the growth rate for these guys. And actually, based on this number, it looks like the dividend has gone down over the last 5 years. And clicking over to FRT real quick, we can see that there's a different story here. Over the last 5 years, they have a growth rate of 3.11%. And like I mentioned earlier, going back to SPG, let's go over to this dividend growth page. So just because they haven't been growing their dividend doesn't necessarily mean that they have cut it. So looking at all time here, going back to 1998, it looks pretty good. We can see that there's been a few times they have cut their dividend back in 08, 09, and then started growing it again back in 2010 and grew it all the way going into 2019, where they cut the dividend just a little bit. But like I said, they haven't stopped paying it, which would be even worse. And then going to FRT, the same thing. We need to find that page. FRT is a totally different story. Consecutive growth year over year over year in the same amount of time since 19. Well, actually, we have more history to look at for FRT. So since 1989, they've just been growing it year over year over year. And that's reflected on the page that we already looked at, this dividend scorecard, where the dividend growth is 52 years. So just in terms of dividend, guys, which is actually a very important aspect to choosing these stocks, because ideally that's why you're buying them is for the cash flow. But just in terms of the dividend, FRT takes the cake. So we have covered a lot of ground so far, and we have taken in a lot of information on both of these stocks. And it begs the question, and this is really the whole point of the video, which one is better? If you're gonna invest in one of these two, which one should it be? Now, overall, this might sound like a cop-out answer, but it really does depend where you're at in your investing journey, which is something I'll get more into. But for me personally, this might come as a surprise, but SPG seems like the better investment. And the reasons being, guys, so number one, okay, SPG has that better debt to equity ratio, which we covered. Number two, there is a much more balanced payout ratio for SPG compared to FRT, which in my opinion, if things get tough, it's going to better allow them to sustain the dividend and also have income left over to expand operations and further the business. And there's some other benefits too to this that we kind of talked about, like setting aside cash for emergencies. It creates the opportunity to potentially pay more out to shareholders in the future, because they can always increase their payout ratio. They have a lot of room to do that. FRT, not so much, because they are a lot closer to that 100%. And true, while SPG's dividend has taken a hit, okay, it definitely doesn't have the years of growth that FRT does. But guys, I'm only 27. years old. I have a lot more years of investing left in me. I don't need this cash flow right now. So by buying into SPG now when the dividend is, taking a big hit, like I said, it's going to create the opportunity to establish a great yield on cost position. And if you are in the same position as me, investing in it right now will give you the opportunity to hop on board and enjoy the ride while they build that dividend back up over time. Okay, and the key phrase right there is being over time. Now, going back to what I was saying like just a minute ago, which one is better depends on the situation that you're in. If you are someone who is younger and has a lot more years of investing left in you, such as myself, I'm only 27, you have a greater threshold for risk. So even if they build their dividend back up, for the next 10 years and cut it, it's okay because you still have so much time. The same cannot be true if you are someone who is older and maybe needs to take this cash flow and take this income in the next 5-10 years or so. You'll want something that's a little more secure like FRT as far as dividends go. And so like I said, guys, it just depends where you're at, but SPG seems like the better decision for me. And just to kind of wrap this section up, if the current state of SPG's dividend is still of concern to you, heed these words from SPG's CEO and president, David Simon. Mr. Simon goes on to say in their recent press release from February 8th, 2020 was a difficult year for all those affected by COVID-19, including our company. Okay, he goes on to say, we feel confident we have turned the corner and we expect growth in earnings and cash flow in 2021. Even with the unprecedented operating environment over the past year, we generated over $2.3 billion in operating cash flow, made strategic investments in widely recognized retail brands at attractive valuations, and have already made significant progress in repositioning these brands and increasing their operating cash flow. They have raised over $13 billion in the debt and equity markets. They have opened 2 new international shopping destinations, expanded 2 others, and completed 3 domestic redevelopments. And last but not least, returned more than $2 billion to shareholders in cash dividends paid. So all sounds pretty good, and it sounds like SPG has a bright future in 2021 and beyond. But really, guys, we're just gonna have to see what happens. But between the two, I think I'm rocking with SPG. All right, my friends, well, that pretty much wraps it up for today's video. I hope you guys enjoyed this one, got some good info out of it, and had fun watching it. Let me know in the comment section below what you guys think. Are you team SPG or are you team FRT? I actually have a feeling we're gonna hear a little bit of both. This is just my conclusion based on the research that I've done. Now, having said that, I am still relatively new to this stuff, guys. I don't know 100% what I'm doing, but I am taking this information, taking it in, analyzing it the best way that I know how, and putting it out there for you guys to hopefully learn something, or at the very least, spark some sort of conversation around it, because like you guys, I am still learning this stuff every single day. And I'll tell you what, being able to bounce these ideas and these opinions off of you guys or other people is very helpful. So I welcome any sort of different opinions or any sort of different ideas. Please leave them in the comments below. I would love some more insight on this and would love to know what you guys think. This is just my take on the whole thing. All right, guys, now before I sign off, if you haven't done so already, please give this video a big thumbs up. It really means the world to me, and it helps this channel out a ton, that positive engagement or just engagement in general. Also, if you haven't done so already, please leave me a comment below. Let me know your thoughts on this video. Let me know your thoughts on SPG versus FRT. And, also hit that subscribe button if you enjoyed this one and want to see more of my videos. All right, my friends. Now, with that said, I will get out of your hair. Okay, thank you guys again so much for watching. I hope you have a great day, and I will see you in the next one.